I want to thank Rob for a great presentation. I just have one small item that I'm somewhat upset about. I think you probably know what it is. So Rob, let me see if I can explain it this way. When you're over 60 and you're a guy, the last thing you want to see is a picture of yourself next to Brad Pitt. Okay? So you need to work with me on this one. So just to summarize some of the issues that Rob was alluding to about troubled times, he talked about the euro, the fact that the American stock market, certainly from a Canadian's perspective, has not made any return at all. It's had a negative return since 1999. Obviously, bonds of the US and Canada are under 2% a year. Balanced portfolios in Canada, you saw the original slide that David presented. If you take out inflation out of those numbers, you have had a 0% real rate of return on balanced portfolios for a little over a decade. I don't know if any of you had a chance to see the latest Maclean magazine. This is the housing bubble that they're talking about. They think that Canada is looking at a housing bubble and a correction that will make what has occurred in the US look like a picnic. And we're seeing potentially a hard landing in China. So what do you do when you're in this environment? Well, our view is you just don't worry, you be happy, and everything will work out fine. And part of the reason we believe that is because we think that if you stay with a process that involves the following, you have a plan, which is a structured plan, financial, retirement, estate plan. You focus that plan on reducing taxes, which are a fairly significant item in terms of how you build wealth. You build a cash flow portfolio, and then what I'm going to do some time at the very end is take a look at trying to put all of those things together to see how they can improve your results. So we talked earlier about the portfolio puzzle. David talked about the mix of assets. And the general issue for us is we're trying to get something like 80 to 90% of that portfolio to generate cash flow. And from our perspective, in terms of objectives for clients, we would like to see them preserve that capital and not utilize the capital for income needs, and basically take all of their income needs out of the cash flow from the portfolio. Now, people that own income-producing real estate do this as a matter of course. They don't spend the capital. They don't take out a mortgage on the building or sell part of the building. They basically just spend the net rental income. So let's take a look at this from a different perspective, a Dilbert perspective. What might be a reasonable long-term financial goal? Well, I think this represents it pretty well, which he says, I did nothing today and I still got paid. That's the ideal thing for a long-term financial planning. You have an income without the need to work. You may want to know where we have developed our sophisticated ideas for investments and planning. I can't speak for Rob because he's a CFA. For me, this is one of the most valuable books in my library, Cash Flow for Dummies. Although, to be fair, I did get the advanced version. When we're talking about equities and long-term performance, this is a slide some of you may have seen in the past. It's a slide sort of to prove that if you invest in stocks for the long run, you'll massively outperform fixed income investments and even investments such as gold. So this, and it may be a little hard to read at the top, shows what $1, that's just one single dollar in equities, in large cap equities, is worth from 1925 to 2006. So for an 80-year period of time, it's $3,000, whereas the same dollar in bonds is only worth $72, and the same $1 in terms of inflation is about $11. So it looks like there's no contest here. Obviously, to build wealth, it's simple. You just buy stocks. Unfortunately, unless your retirement is going to be about 80 years long, there are going to be some iterations here where that doesn't work out. So when we take a look at real returns, this is net of, so what I've done here is take the returns of different asset classes, subtracted what you would reasonably pay in fees, and also subtracted what the effect of inflation was. The real returns on small cap stocks is about 7.5% a year. On large cap stocks in real estate, just over 5. On corporate bonds, just over 2. And on gold, 1. And the last item might surprise a lot of people because most people believe that buying gold, obviously, especially for the last 5 or 6 years, maybe even 10 years, has been one of the best investment choices ever. But over an extended period of time, what you would expect to see from gold is it will maintain its purchasing power in terms of inflation. Over the long run, what it's proved to do is generate about a 1% real rate of return, which is fine, as Rob says, as an insurance strategy, but it's not necessarily a strategic asset in terms of building wealth or generating cash flow. So let's take a look at this 5% return, because the problem is that while there is this 5% return, it's really uneven. So what you're looking at here is the average rate of return for a small or large cap stocks is 5.3% a year. But for 20 years in the 30s and 40s, it was way under that. For 20 years in the 60s and 70s, it was well under that. And for the last decade, it has been the lowest it has ever been since they've been recording rates of return by decades. In fact, in the last 10 years, the rate of return on equities is 6% worse after inflation and fees than it was in the 1930s. So part of the reason why people have fared so poorly in equities is they don't realize exactly how much of a bubble that 1999 market actually was. So let's talk about a story, Aesop's fable, the tortoise and the hare. And in this particular case, we're going to look at the tortoise being bonds and the hare being stocks. And as you know, of course, you all know how the story is going to end out. But let's just play along with this. So typically, of course, the stocks, you would expect them to outperform bonds. But in 1981, bond rates were 18%. So it was neck and neck. And until 1999, the stocks took off during the 90s, were well ahead of bonds. And then after the dot-com crash, they got very close to being even. They took off again. Stocks crashed in 2008. And by December 2011, the tortoise just eked a small victory. And the reality is, of course, that means that for 30 years, buying relatively safe government bonds outperformed buying blue chip stocks. The problem, of course, is this. This works great in a market where bonds have gone from 18% to 2%. They can't go from 2% to minus 16% in the future. So the challenge here, of course, is we'll never see this bull market that we've seen in bonds in the last 30 years again. It simply won't occur. So if we take a look at the 8 or 9 years before 1981, from 1973 to 1981, the market was quite different. People who invested in bonds in that decade had a negative return of 5.3% a year. They lost about 40% of their capital in real terms. And if we combine these two markets together, over 40 years, bonds have done really well, averaging 4% a year after inflation. But it's two markets, one massive bull market, one relatively short bear market. So now we have to take a look and say, well, where does that leave us today? Well, Rob pointed out what the 10-year bond yields were for US, Canada, Germany is about the same. Switzerland and Japan are even lower. So you have to ask yourself, what will the return be after inflation, fees, and taxes over the next decade? It's a very interesting challenge. And Rob's observation that there's a reason to have fixed income investments, there's no question about it. But you've got to have relatively short durations, I believe. So for my money, the short duration fixed income assets are, number one, a place to hold cash, a place to preserve capital. They're not going to generate a lot of the income you need in a portfolio, not in this environment. And in Europe, as Rob points out, I don't know if you know that they just finalized the transaction for private bondholders, not public bondholders, but private bondholders of Greek bonds. And they've agreed to take basically 30 cents on the dollar. Now, what you may not realize is one day after that deal was done, those bonds were then trading at 40 cents on the dollar. That is the residual. So essentially, the marketplace doesn't think that Greek bonds are worth 30 cents on the dollar. They think they're worth about 10 cents on the dollar. And the reality is, I doubt very much if Greece can pay back anywhere near the capital they have outstanding. And the question really is, for the other countries in Europe, will they be able to deleverage at a rate that they can functionally afford? And Rob alluded to this earlier. One of the things in Europe, and when I took a look at this, I went back and looked at currency rates in Europe before the euro was created. And to a large degree, personally, I think the euro is a dysfunctional currency because it's not a fiscal unit. They don't have the same ability to enforce financial issues as, say, the US does or Canada does. So before 1999, countries like Greece or Spain or Italy, in order to adjust their standards of living and adjust their competitiveness, they would devalue, and as Rob mentioned. What you might not realize is how much they devalued. Greece, in 50 years, devalued 96% against the German mark, Italy 84%, Spain 82%, whereas the German, the Swiss franc went up 20%. This doesn't mean their standard of living dropped to 96% compared to Germans. In fact, there's not actually a huge difference between the Italian and Spanish and even Greek standards of living and that of Germany. This is what was necessary to keep their countries competitive. So they lost that the minute that they joined the euro. 50 years of devaluing to prosperity basically ended. And functionally, you've got to ask yourself, can we see not just Greece leaving the euro, but is the idea of the euro logical? Rob talked about emerging markets and global bonds, and I think that that's an area that really is worth taking a look at. Because generally speaking, we've looked at emerging market debt as riskier debt. You know, you're lending to these growing, developing countries, you know, it's higher risk. But if you take a look at this chart here, which is giving me vertigo just looking up, this is the average debt to GDP of the developed world, about 106 to 110% of GDP. But you see in the developing world, essentially what's happening is their debt is actually shrinking because their economies are growing faster. So one would seriously argue they got better balance sheets, they've got better cash flow, and they're growing faster. Yet their interest rates, in many cases, are considerably higher. These are the interest rates for 10-year bonds as of about a month ago for Thailand, China, India, and Brazil. So it's not everywhere where your only option is to buy 2% 10-year bonds. So we are in favor of fixed income investments, as Rob says, and these are just some of the ones we look at that we think are relatively safe. So let's talk about the stock market, because the stock market has been in the doldrums for about a dozen years now, and it's a reasonable question to ask, how long is it going to take before the market gets back to anything like historical returns? So let's take a look at the price, and I'm going to go back to 1971 because I want to be able to compare the stock market to the real estate market in this time frame. So in this 40-year period of time, the stock market spent the first 10 years with no returns in the 70s, had an incredible bull run for almost 20 years in the 80s and 90s at 14% a year, and then has had a negative rate of return for the last 12 years. Overall, the market has gone up 6% a year. This is just the price of the market. This does not include dividends. So the problem with doing any projections based on price alone is you're dealing with a very volatile asset. But let's look at the flip side of the market, which is what is the income it generates? So we're going to look now just at the dividends generated by the American stock market. And that line looks a lot different. In the first 10 years, dividends rose by about 7% a year. In the next 20 years, they grew by about 5% a year. And in the last 12 years, they've grown about 5% a year as well. In fact, overall, just over 5% a year. And there's only been 3 or 4 years in the last 40 when dividends for the American stock market have ever dropped, and they've never dropped by more than 6 or 7%. So in other words, what we can say is the income on the market is predictable and the price is completely unpredictable. So if we look at it from a cash flow perspective, this is what it would look like. If you were sort of a Rip Van Winkle investor and you put in $100,000 in 1971, your annual dividends would have been $3,000. If you woke up 10 years later, they would have been $6,000 roughly. They would have almost doubled again to $12,000, grown to $16,000 in 2001, and $30,000 a year today. And that is a rate of return. That income is rising about almost 6% a year. significantly more than inflation. So if somehow I could magically ignore the price in the market and just look at this as a cash flow vehicle, this is actually doing the job. And in fact, in the last decade, when I've made no return, my income has almost doubled. So it depends on the perspective you have on the marketplace. And the other thing that Barron's pointed out just recently in one of their articles, American companies only distribute 28% of their profits, one of the lowest levels in the last 50 or 60 years. And the yield on the S&P 500 is only 2.2%. They believe that most American companies could comfortably get, at today's price in the markets, between 3 and 4% as a yield. So this $30,000 a year of income could dramatically increase. It could increase by almost 50% and not strain the balance sheets or the income requirements of these companies. So let's take a look at how it compares to real estate. So in the case of, I'm comparing, unfortunately we don't have hard data for what I call real estate, so we have to use real estate trusts. And we have data for that going back to '71. So we're going to look at, first off, this is the yield, this is the income yield for the stock market by decade for the last 40 years. And this is the income yield for real estate trusts. So this is important to understand this difference. So real estate generates a higher yield pretty well at any given point in time. The question is, does it generate a higher total return? So if we just looked at the price alone, we put in $100,000 40 years ago, if we put it into stocks, it would be worth about $1,240,000. If we put it into real estate trusts, it would only be about $500,000. So there's no question, on price alone, the stock market has well outperformed real estate. But if I look at the total return, if I reinvest all the dividends or all the income from the real estate, the compounding effect of that would make the real estate portfolio worth double what the stocks are. Now, part of the reason for that is that real estate has had a pretty good run, and this includes at least 22 years of bear markets for stocks. So my guess would be that over the next 30 or 40 years, there's no reason to think that there should be a higher rate of return for income-producing real estate over equities. And given how poorly equities have performed in the last 12 years, you could make a pretty good argument that they might actually outperform and revert to the mean.